Hello and welcome to our web chat, where we are continuing our series on corporate treasury operations. This time we'll be looking at how to measure corporate treasury department success. For this, we're joined by Bruce Lynn, Managing Partner at the FECG, a financial and treasury consulting firm based in the US, providing executive staffing advisory services, who's had many years' experience, and I'm sure many of you will know him anyway. Welcome.
Well, Jack, thank you, and good morning or good afternoon, depending on where you're located.
Yep, they're all over the place. Okay, so if we move to the first slide, the traditional treasury, this is a build slide, but it gives a pretty traditional view about the current focus on processing, etc., for the corporate treasury department. How would you explain this, and why is this so serious?
Well, based on prior experience and in conversations with other corporate treasurers, what I have seen is that the majority of resources within a treasury department is based on the bottom part of this triangle, really transaction-oriented. Obviously, transactions have to be processed every day, determining where you are. But I don't think it really gets to where treasurers wish themselves to be. And based on surveys that I've seen, the idea that Treasury wants to become more strategic, yet it is sort of bound up in their need to get the work done every day by processing certain transactions, leaving little room left over to think about where you would be and how much liquidity is enough or how much risk is too much.
So what's the solution then?
Well, I think the solution is to think about a different model, and rather than have an internal focus, I think you need a new model that looks at Treasury's ability to have an external as well as an internal focus.
So shall we move to the next slide?
Yeah, and I've created a model that, again, it's a 50,000-foot level slide, but I think it encompasses all of the functions that Treasury should focus on, with a realization that they need to look at the markets. I mean, certainly that's where the external sources of liquidity would come from. It's where risk appears, changing in interest rates, changing in foreign exchange rates. And as the company has its own goals, where it wishes to be and what markets it wishes to compete in, Treasury has to make sure that there is enough liquidity and not too much risk. And again, thinking about these bullet points on the bottom, I think if you follow these to their conclusion, you will move Treasury from its traditional processing role into a more strategic function within the company.
What does strategic function mean? I've always been a bit troubled by that.
Well, a strategic function, I believe, means that you're really working with the business units to help them achieve the goals. A company is in business to sell services to its customers and, quite frankly, to do it better than its competitors. Better means that it has a larger market share, or perhaps is more profitable, has more innovative products. But each of these requires an investment and certainly time. So where does that time, talent, and treasure come from? Hopefully internally. Hopefully you're generating enough cash flow so that the cash you generate today can be used to invest in tomorrow. But if you can't do that internally, you need to do that externally. And that's the left-hand side of this screen, in which you have to know what the markets want. Now, the markets are basically uncontrollable. No one company, no matter how large, can do that. So you have to then look at the markets, go back to the companies, and it's a back and forth situation, but you have to look at just beyond the transaction of paying the vendor or paying multiple vendors. Processing transactions is really not the business of Treasury. It has to do with supplying the kind of financial resources that a company needs to to become or remain competitive.
Yeah, you argue that the focus of Treasury is on liquidity and risk.
Yes.
The problem is, how do you measure that?
Well, there are many different statistics that you can use. Obviously, it depends on the industry. But I think that there are some that make sense, at least to start with. I don't think you want to become too complicated too quickly. And as you see in this slide, you can start very simply by looking at your cash on hand. I can't tell you how many companies spend a lot of time sort of debiting and crediting this account or that account without making a determination of, okay, I've got $10 million in the bank. Is that enough? Should that 10 become 20? In other words, what's my target for my cash on hand? And what about free cash flow and other statistics that you see here? I mean, if I had to hang my hat on one figure, it would be free cash flow. And a perfect example of that is that the rating agencies will downgrade you if you don't have enough free cash flow. And that happened to a very major company within the last week, where S&P downgraded them because their free cash flow was not enough to support the actions that management wanted to take when it came to stock dividends. And again, you have other numbers or other metrics here. Each one is more or less important depending on the industry and where you are. But the one common denominator about all these statistics is that they're really not P&L driven. They're balance sheet and cash flow driven. And I think that is where you need to focus if Treasury is going to move from the traditional model to the strategic model and keep the company competitive.
But I rarely see a list like this of measuring Treasury success. Why is that?
Well, I think success is one of the issues that everybody has to face. I mean, if you talk to your CFO or even your board of directors and said, "Okay, Mr. Company, how do you measure success?" Typically, you'd get answers that really are P&L driven, market share, sales, EBITDA, and I don't disagree with any of those. I think that that is a set of metrics that are important, but they're a little one-dimensional. You have to consider your cash flow. You have to consider your balance sheet. I mean, when your liabilities start exceeding your assets, the balance sheet becomes important. But if you don't know that in time, you're in trouble. So you need a what I'll call a multi-dimensional view. And these metrics here try to tie the balance sheet and cash flow statement into the P&L. And that, in my mind, is the strategic view that every company should have.
Is there any treasury management system that combines all these to assess the success of treasury operations?
Well, bluntly, no. There are some systems that come closer than others. But for example, cash on hand, yes, absolutely. The treasury management system will do that. Free cash flow or cash conversion cycle, for example, no. Debt headroom, yes, they can do that. They'll take a look at outstanding debt versus the total amount available under a credit facility. But leverage, for example, I mean, try asking your TMS whether you are over-levered, whether your total liabilities as a percentage of equity is high, low, 1 times, 2 times, whatever, however you want to measure that. Try asking your treasury management system what your DSO is. It really can't be done. Now, can you do it? Absolutely. You can combine information from your TMS with your ERP or some spreadsheets and whatever. But that is I want to say a little bit of a time waster. And therefore you need a strategic system to really look at that.
So what we're really talking about in measuring the success of Treasury is a strategic TMS.
Yes, I think that TMS is, if you look at the history of a treasury management system, They started off as processing engines. You can go way back to the first ones, probably about 20 years ago, and look at what they were designed to do. But today, if you had a compliance question, or you had a question about stock buybacks, or you had a question about debt covenants, your TMS is not designed to do that. So you have areas where what do people do? They pull out a spreadsheet. Many surveys that I've seen, and even recent surveys, have really said that about half the people with TMS still depend on spreadsheets. And I find that to be a real head scratcher unless you think about some of these statistics and why a TMS doesn't get to it and why you do need something else, which happens to be a spreadsheet.
The recent PwC Treasury benchmarking survey, which is excellent, by the way, believes that, and they quoted from their survey of CFOs, that what you need is a change in digital framework and a digital ecosystem that brings everything together to give you the control that you need.
Yeah, I don't think as much as I don't think that a lot of these ideas, quite frankly, are all that startling. The question that still causes me some angst is why hasn't this been done? And it leads me to believe that the importance of some of these issues is less than they should be. Now, again, every company is different. I think companies that are below investment grade might take some of these metrics and others more seriously. But those that are above investment grade, single A, double A, and that rare triple A creature might not worry so much about liquidity and risk. So again, the seriousness of this depends on situations, perhaps by company or even by industry.
Which of these 7 metrics is the most important in your mind? Number 2.
I think number 2.
Can you explain free cash flow in a bit more detail, please?
Sure. Well, as I said here, free cash flow is operating cash flow less capex and less dividends. Now, what that means in essence is that I have an operation, I'm in business to sell widgets. And the question I have to be able to show is, does the cash I receive from my sale of my widgets allow me to invest in the future and pay my shareholders? Because if I can't do that out of my operating cash flow, why would a third party, a bank or the capital markets, why would they invest in my company? If I can't return cash to them, then why would they invest in my company? And I think that's why free cash flow, and as I mentioned before, even the rating agencies take this seriously in that they look at many factors, obviously, and free cash flow is one of them. And same thing with the banks. So if you're looking for external sources of funds and you cannot convince those investors or that bank that you can return cash to them, pay down your debt, for example, they're not going to play with you.
Very, very interesting, Bruce. What would be your closing comment, the thing that you feel sums it all up?
Well, I think that Treasury is a vital part of any organization that wishes to remain competitive in its chosen marketplace. And a show of importance by the company should be similar to what the company does with other areas in the organization, which is to reward people for performance. If you are a salesperson, you get a bonus for meeting your sales targets. If you are an operating person and you generate more EBITDA, you get a bonus for that. I think that Treasury and others in the company, especially at the operating business level, should be rewarded for generating cash flow as well as profits. That's happened to some companies that I have worked for. They have seen the light, if you will, And they would argue that their performance has improved by making cash flow a part of the reward structure.
Fascinating. Thank you very much.
Well, thank you, Jack.